Great to have you on Benchmark, Nick. Against the backdrop of what's happening on the global stage in recent times, how are you seeing the business landscape of the country unfolding?
I think if you look at 2010, you could say the economy is in pretty rude health. Looking at the results that came out for 31st December, either third quarter or full year, for most of the major companies, the conglomerates and others involved in the natural resource sectors, they all reported very, very good results, significant increases in profit, and that's pretty much across the board. So I think we're definitely seeing the economic recovery that everyone was hoping for post-war. There are some obviously hot sectors, tourism being one. The tourist numbers were a record high in 2010, and it looks like January and February are better than the year before. And on top of that, we're seeing a lot of the tourist sector properties looking to either expand, refurbish, and indeed have some new properties being built. The telcos, all the telcos have recovered profitability. They're all investing in upgrading their networks, and that looks like an exciting sector. And of course the apparel sector, much to maybe some people's surprise, I mean, apparel exports were up 7% in 2010, notwithstanding GSP Plus suspension. You could argue it may have been even better without that, but at least they've proven to be resilient, and I think we're seeing a bit of a global move for production from places like China to places like Sri Lanka and in some cases Bangladesh. And I think obviously the commodity exporters, tea, rubber, at some of the highest prices ever, so they are benefiting from there.
Like you mentioned, speaking of results, the banking and the financial services industry has definitely performed well. If I'm not mistaken, its cumulative corporate earnings up from 27% to 33% in 2010. What factors particularly are driving this?
First and foremost is loan demand. In 2009, I think the central bank figure was a negative 3.5% growth in private sector credit. In 2010, that same figure was 22%, and deposits also grew by a lesser amount, about 15%. So I think the economy at large is borrowing more money. I think banks are facilitating that. There's a lot of liquidity in the market. With the opening of the North and East, there's been more outlets and branches up there. So I think there's just an upswell in credit demand, and also that's been helped by things like drop in some of the tax rates and some of the duties for specifically things like cars and white goods, where you saw a huge increase in demand and purchases, which are fueled a lot by banks and loans. The property market, I think, is still humming along, but not sort of going up too much. And of course then there's the stock market. The stock market was one of the best performing last year, went up I think 100% or so. A lot of the trading that's going on probably is on sort of margin type of activity, so that is helping with bank finance. But I think it's more the overall economic upturn, and therefore a requirement for working capital. If you're doing more exports, you've got to buy more fabric, you've got to buy more inputs, and therefore that is where banks come in to help to sort of oil that working capital cycle.
So looking at the current scenario, are we right in assuming that the relatively low interest regime is affecting the bank's bottom lines?
I think hurt is probably the wrong word. I mean, certainly there will be an adjustment. I mean, with low interest rates, it's a double-edged sword. You're earning less on your loans, but you're paying less on your deposits. So the key is to try and maintain your interest margin. And I think interest margins in Sri Lanka are still relatively high, because the intermediation cost, all the infrastructure used by banks to support their lending are relatively high compared to other places. So the banks all reported very good profits in 2010. I think with the expected increase in economic activity in 2011, we'll probably see similar results. And I say the key is not so much the interest rate per se, it's the maintenance of the margin.
So is there a need to increase productivity and efficiency, and also to bring in cost-cutting measures?
Some or all of those would be welcome. I think one of the biggest issues with the banking sector here is you have, I think it's 22 banks, and a number of them are, I would probably describe as suboptimal in size. So each bank, you have to have a head office, and you have to have a marketing department, an IT department, an HR department, and you have branches and all that stuff. So there is a cost for maintaining that infrastructure. So maybe with some consolidation, bringing together some institutions so you make larger ones, that's good from a capital safety point of view, but it also means you can rationalize a lot of the back office activities, centralize them, take out some of the cost from the banking system. So that will definitely help. In terms of staff numbers, I don't think so. You look at most of the local banks, they're expanding their branch networks. HNB, Commercial Bank have got around about 200 each, People's Bank, Bank of Ceylon, 300 or so branches, and they're opening more and more. That requires more people.
So are we to expect a trail of mergers and acquisitions in the medium term? Also, any insights, any predictions that you can see?
I wouldn't say a trail of. I would think maybe one or two. But again, I think it would all depend on the legislative framework to be set first, and then I think you'll see some activity, including, I'm sure, some overseas interests. And the other issue is the central bank statistics as at December 2010 showed that the return on equity of the banks was about 21.6%, which is up from its normal average, which is not bad, but it's still low compared to other emerging markets. So that too is a slight impediment to foreign investment in the sector. And of course, with the stock market being as high as it is, and some of the most liquid stocks being the banks, and their valuations are very high, it makes them quite expensive to buy at this time.
Now, the banks have been paying an effective tax rate of nearly 60%. And when the budget provisions, the 2011 budget provisions kick in, this may be down to no less than 50%. The banking sector, of course, is one of the chief beneficiaries of the 2011 budget provisions with a view to streamlining the tax regime. What are the main ingredients, do you feel, will buoy the bank's performance this year as a result of the budget?
Well, certainly the lower tax rates are welcome. So corporate tax has gone from 35 to 28%, and financial VAT from 20% to 12%. And the big thing about financial VAT is that's a direct cost. So that shows up in the expenses of a bank, whereas corporate tax is after profit, is after tax profit. So there'll be an immediate improvement in banks' performance because their costs are going down because of the lower tax rate. Now, that will in some way be mitigated by the reduction in interest margin, because obviously interest rates are lower. But I think in general it's a better situation to be in, where you have lower taxes. That will spur more investment, it will spur more reinvestment, which will mean banks can expand their capital. And it needs to happen because the government has a stated aim of going to 4,000 GDP per head in the next few years. The banking capital that would be required to do that, I think the central bank governor said that it'd have to double. So it's important that banks are allowed to A, make profits, and B, reinvest them so that they can provide the credit that is necessary to support the country's economic goals.
So what more can Sri Lanka do to raise the levels of FDIs that we so desperately need? 2010,
I suppose, could be seen as a bit of a disappointment with about 500 million of FDI. This year, the expectation is $1 billion, and it seems that is looking well on the way to get there. I think it's very simple. Investors are not really too bothered where they invest. They're looking more about the return and the certainty and the ease of doing business. So if you can set up that environment, then investors will come. And I think because of the economic development, because of things like the tourist sector, the apparel sector, which are well developed and clearly have potential, they will be attractive to foreign investors. So I think the framework has to be set so it's easy to come here, easy to set up here. The tax rate is at a rate equivalent to other emerging markets, and all the legislative issues are more certain.
So how can we entice the likes of HSBC to expand their investments in this country? Also, what is the competition we are looking at in this regard?
Sri Lanka is an emerging market, so it's competing with all the emerging markets, and obviously we're in the Asia-Pacific region, so it's everybody around. So you've got the likes of Vietnam and Thailand and Philippines, you've got obviously India on the doorstep, and all these countries are looking to attract foreign direct investment and by and large have been successful in doing so through policy, through enticements and all sorts of other things. So I think these places have got to be looked at to see what they did well, and they didn't do everything well, and therefore model the BOI here on the best practice of all of these things to make sure that Sri Lanka does become a destination of choice for foreign investors.